The 62 number you've built your entire financial life around was not designed by a retirement planner. It was not based on research about human productivity or health or what age you stop enjoying your work. In 1961, Congress lowered the Social Security retirement eligibility age from 65 to 62 for men, and the logic behind it was purely actuarial. In 1960, US life expectancy at birth was 69.8 years, and for men specifically, it sat around 66 and a half. The committee designing the program wasn't building you a retirement system. They were designing a payout system with the expectation that most claimants wouldn't collect for very long. And here is the part that changes everything. The tax code has been silently building an 18-year financial optimization window between the moment you could stop working and the moment the IRS forces your hand. Most people never open it. The ones who do retire earlier pay less in lifetime taxes and end up with more money than the people who stayed in the conference rooms grinding towards 62. This video is about that window. I'm going to show you the actual arithmetic, not the motivational version. If the math says you should keep working, I'll tell you that too. But I suspect for a meaningful portion of you watching this right now, the math says something different than you've been told. Your career is a lease on your time. Every paycheck is a monthly rent payment. For most of your working life, that lease made sense. You were building equity. You were loading the 401k, compounding the brokerage account, paying off the mortgage. You were constructing something. The rent made sense because you were acquiring the building. But at some point, the construction finished. The equity crossed the threshold. The building belongs to you now. And instead of moving in, you're still paying rent because the lease was written to expire at 62, and no one ever told you that you're allowed to terminate it early, or that the early termination fee is dramatically lower than the ongoing rent. Every time I say lease trap in this video, I want you to hear paying rent on a building you already own. Now, before I get to the tax mechanics, which are the genuinely interesting part, there's a wall that gets raised the moment this conversation starts. And it has to stop so many people from thinking clearly that I want to take it down with real numbers first. The healthcare gap. Ages 55 to 65 before Medicare begins. For most people, this isn't a planning concern. It's a full stop. The perceived cost of covering health insurance for 10 years outside employer-sponsored coverage has killed more early retirement plans than any market crash I've witnessed in my career. I want to show you why that fear has been calibrated larger than the actual problem. When you separate from an employer, COBRA extends your existing group health coverage for up to 18 months. You pay the full premium without the employer subsidy. For a couple in their mid-50s, costs typically run in the range of $600 to $2,000 per month, depending on the prior plan. That number is uncomfortable. It is not catastrophic. It buys you 18 months of full continuity while you transition. After COBRA, you enter the ACA marketplace. And here is the lever that most people in the fear conversation never get to. ACA subsidies are based on your modified adjusted gross income compared to the federal poverty level. Not your assets, not your net worth, not your brokerage account balance. Your income as declared on your tax return. A 55-year-old early retiree with $1.5 million in investments who manages withdrawals intelligently to show $60,000 in taxable income still qualifies for meaningful premium subsidies on a solid silver plan. Here's where the 2026 landscape matters, and I want to be direct with you about it. For 2026, the pre-2021 rules are once again in place and will remain in place unless Congress acts otherwise. The enhanced subsidies that ran from 2021 through 2025 have expired. Early retirees who manage their annual income below 400% of the federal poverty level in 2026 can still access subsidized ACA plans. For a couple in their mid-50s, 400% of the federal poverty level works out to roughly $84,000 in household income. As a real-world example, a single 60-year-old in Mobile, Alabama, with a household income of $60,000 gets a subsidy of $827 per month on the lowest cost bronze plan, bringing the premium to $0 per month. The subsidy cliff is real. $1 above the 400% FPL threshold, and the subsidy cuts off entirely. which means income management in retirement isn't optional, it's the game. But that's a planning discipline, not a deal breaker. A 55-year-old buying a silver plan on the ACA marketplace without any subsidy pays approximately $977 per month based on 2026 benchmark data. That's the worst case, unsubsidized, for a single person. For a couple who manages withdrawals to stay under the subsidy threshold, the number looks much more manageable. If you budget $800 per month for healthcare as a couple over the 7-year bridge from 55 to 62, you're looking at $67,200. Real money. For someone with a 7-figure portfolio, not a portfolio ending number. And that's before you account for the fact that many early retirees see meaningful reductions in healthcare spending within 18 to 24 months of leaving high-stress employment because the primary driver of their medical costs was the job itself. I know a man named Gerald. He was a regional VP at a logistics firm in Charlotte. He retired at 56, 2 years before he'd planned, because his doctor connected the dots between his blood pressure medication, his sleep disorder prescription, and the fact that both had started within 90 days of his last promotion. Gerald spent the first year of retirement on the ACA marketplace. He managed his income carefully. His monthly healthcare cost was $640 for a silver plan for him and his wife. Within 14 months, his doctor had eliminated both prescriptions. Gerald ran the math. His actual healthcare cost in year 2 was lower than it had been in his last year of employment when you account for all the stress-driven medical spending that simply disappeared. The lease trap runs on healthcare fear. When you put a real dollar figure on the fear, it shrinks to fit the actual object instead of the imagined one. In a few minutes, I'm going to show you the specific tax architecture that makes retiring at 55 financially superior to 62 for a specific category of person, superior in a way that shows up as real dollars in the final accounting, not just in lifestyle quality. But stay with me because this next part changes everything, and it requires understanding what gets destroyed during the years you're still employed. The framework I use for this is what I call the 3-window strategy. These are 3 distinct financial opportunities that only exist when your taxable income is low, which only happens when you're not collecting a high professional salary. Every year you're employed past the point of financial independence is a year these windows are closed. Working until 62 doesn't delay these opportunities. It eliminates them. Window 1 is the tax valley. When you stop collecting a W-2 paycheck, your taxable income drops dramatically. If you're drawing from a thoughtful mix of Roth accounts, taxable brokerage accounts, and calculated pre-tax IRA distributions, you can structure your annual taxable income to fall in the 12 or 22% federal bracket. For married filing jointly in 2026, the 22% bracket begins at $100,801 in taxable income, and the 24% bracket begins at $211,401. With a standard deduction of $32,200 for a married couple, most early retirees spending at a comfortable level operate well below that ceiling with room to spare. Now here is what happens at the other end of the timeline if you don't use this valley. You generally must start taking withdrawals from your traditional IRA, SEP IRA, Simple IRA, and retirement plan accounts when you reach age 73. The RMD formula divides your prior year-end balance by your IRS life expectancy factor, which is approximately 26.5 at age 73. If you have $1.5 million in a traditional IRA at 73, your first year required minimum distribution is approximately $56,600. That's not money you chose to withdraw. That's income the IRS assigned to you. Layer Social Security on top of that. And suddenly, a retiree who believed they would have modest income finds themselves in the 24 or 32% bracket through no decision of their own. And that bracket follows them for the rest of their life. The tax valley between 55 and 73 is an 18-year window. Working until 62 shrinks it to 11 years. And during those extra 7 working years, the window does not merely get smaller. It does not exist at all. You're in the upper brackets the entire time. Window 2 is the Roth conversion opportunity inside the valley. This is, in my view, the single most underutilized financial optimization available to high net worth Americans, and it requires early retirement to execute at scale. A Roth conversion moves money from a pre-tax retirement account, a traditional IRA, 401k, or 403b, into a Roth IRA. You pay income tax on the converted amount now, and in return, the money grows tax-free, and qualified withdrawals are never taxed again. For a married couple with no other income in 2026, the conversion capacity in the 12% bracket alone is approximately $133,000. A $100,000 conversion, growing at 7% for 25 years, becomes $542,743 of completely tax-free money. Run that math across several years of conversions inside the tax valley, and the numbers become genuinely significant. If you convert $60,000 per year from traditional to Roth during years when you're in the 22% federal bracket, you pay $13,200 in federal tax on that conversion. Over 10 years, you move $600,000 out of the pre-tax bucket at an average effective federal rate of roughly 22%. That same $600,000 left in the traditional account would generate forced distributions at age 73, pushing you into the 24 or 32% bracket. On $600,000, the difference between a 22% rate and a 32% rate is $60,000. $60,000 in extra taxes that exist purely because you didn't use the conversion window. That's not a fee. That's a voluntary donation to the federal government made out of failure to plan. And that calculation does not include the tax-free compounding on the Roth assets after conversion, which over a 30-year retirement horizon is substantial on its own. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Window 3 is the 0% capital gains opportunity. One of the most powerful early retirement strategies is the 0% long-term capital gains rate, which applies to taxable income up to approximately $94,000 for a married couple. Early retirees with low ordinary income can realize substantial capital gains at 0%. In years when Roth conversions keep your taxable income in the 0% LTCG bracket, you can sell appreciated taxable brokerage assets, pay zero federal capital gains tax, and reset your cost basis to current market value. If you have appreciated securities in a taxable brokerage account, and most people who have been investing steadily for 20 or 30 years do retiring into a low-income year, gives you the ability to sell those positions, realize the gains at 0% federal rate, reset the cost basis, and reinvest. Working until 62 makes this structurally impossible. You're earning a six-figure salary that places you above the 0% threshold for the entire 7 years. Here's the part that never makes it into a standard retirement calculator. I built something called the exit code specifically because I kept finding that people had the right instincts about early retirement, but no rigorous framework to act on them. It's a digital book built on 50 years of actual retirement data, not opinion. Two things in it connect directly to everything I've been laying out. One is the 4% trap and the dynamic withdrawal method that replaces it. The static 4% rule assumes you spend the same amount every year in retirement, which no one actually does. The dynamic version adjusts withdrawals based on portfolio performance and gives you specific guardrails for down years, which addresses the sequence of returns anxiety that keeps people in the lease trap long past when they should have left. Two is the mathematical framework that turns maybe someday into a specific date. Not a target savings number, a calendar date derived from your specific portfolio, your withdrawal flexibility, and your actual tax situation. The book is 8 chapters of pure research, no filler. You can get it for less than 1 hour with a mediocre financial advisor through the link in the description. Every year, you weight compounds against you. That's not marketing, that's the mechanism. Now let's get back to the real cost, because the 3-window strategy shows you what you gain by leaving at 55. What you also need to understand is what you pay for staying from 55 to 62. And this number surprises every single person I walk through it. I want you to calculate your real lease cost, not the emotional version, the actual dollar figure. every monthly expense that exists solely because you work. Commuting, professional clothing, the premium you pay on convenience, food, and services, because you're too exhausted to manage your time efficiently. The average commuter in the United States spends approximately $8,466, and about 19% of their annual income on their commute every year, according to an analysis by Clever Real Estate. That's just transportation. Add professional wardrobe maintenance, dry cleaning, work lunches and dinners that happen because you can't cook at 8:30 at night, any healthcare spending that demonstrably correlates with your stress level, convenience subscriptions you wouldn't need if you had time to manage your own life. Most high earners in demanding professional roles find that sum somewhere between $12,000 and $20,000 per year when they're honest about the full inventory. Multiply $12,000 by 84 months. That's 7 years of lease payments. That is $1,008,000 in pure cash outflows that evaporate the day you retire. Before you count a single dollar of tax opportunity costs, before you count the 3 windows, before you count the compounding drag of keeping pre-tax money in a high bracket environment for 7 additional years, you're not being financially disciplined by staying. You're running a calculation that excludes most of its own inputs. This is where I need to bring in Dave. Dave is drawn from roughly 15 separate conversations I've had with men between 52 and 58, who all arrived at the same fork in the road at approximately the same moment. Dave is an operations director at a manufacturing company in the Midwest. He's 54 years old. He has $1.8 million distributed across a traditional 401k, a taxable brokerage account, and a Roth IRA. His house carries about $200,000 remaining on the mortgage at 3.1%. His kids are grown and out of the house. His wife would retire tomorrow if she could. And Dave says, "I'll probably work until 62. I want to make sure we have enough." Dave's problem is not the portfolio. You can tell that already from the description. His lifestyle cost exercise, where we built a line item monthly budget for the retirement he actually wanted and subtracted the work-related expenses that would evaporate, showed his retirement spending would be roughly 21% lower than his current spending. Dave was financially ready. The math was clear. His portfolio, even before the 3 windows, was sufficient. Dave's problem was something that had nothing to do with numbers. 14 years as operations director had fused his sense of competence, status, and daily structure to that role so completely that retirement had stopped being a financial question and had become something else. A grief process, a loss of self, wearing the costume of prudent financial planning. And the 1 more year syndrome was his coping mechanism. Legitimate sounding, respectable, essentially impossible to argue with in a normal conversation, because who is going to tell someone they need to stop being careful with their money? The research on this is not soft. Losses feel approximately twice as painful as equivalent gains feel good. The anticipated loss of professional identity, status, daily structure, and intellectual challenge feels emotionally like losing roughly twice the monetary value of whatever you might be leaving behind. Your brain is not running a financial calculation when it says 1 more year. Your brain is running a threat response. And threat responses are designed to be persuasive. They are designed to feel like logic. The 1 more year loop is the most expensive behavioral pattern in personal finance and among the least discussed. At 58, the person says 60. At 60, they say 62. At 62, they say 65 because Medicare. At 65, they're in what gerontologists call the slow go years, grinding through the best physical window they'll ever have access to in retirement, in conference rooms, with a portfolio large enough to fund a very comfortable life that they are not living. When they finally stop, they have more money than they can reasonably spend and less energy than the money deserved. A conversation I have heard described, with slight variations, about 400 times in spirit. Nervous executive to his accountant: "But what if I live to 95? Accountant, who has heard this question approximately 400 times. "Then you will have been retired for 40 years and the money will still be there." Nervous executive, not comforted at all. But what if it's not? The treadmill's most sophisticated move is making certainty sound like it's available if you just stay a little longer. 1 more year, and I'll be sure. 1 more year, and the sequence of returns risk will feel manageable. But certainty is not a feature of any financial system that has ever existed. The question is never whether your plan is certain. The question is whether the life you're living while you wait for certainty is the life you actually chose or the life that happened to you by default. Now, this is where it gets really interesting because the sequence of returns concern is real. I'm not dismissing it. A poor market in the first 2 years of retirement can meaningfully damage a plan that requires high fixed withdrawals. What the financial industry consistently overstates, though, is how exposed a prepared retiree actually is to catastrophic sequence risk. The reason is behavioral. The primary hedge against sequence of returns risk is not more years of employment, it's withdrawal flexibility. A 55-year-old with a diversified portfolio above $1 million who keeps 18 to 24 months of expenses in cash or short-duration bonds, maintains a flexible withdrawal approach, and does not panic sell during market contractions is not meaningfully more exposed to catastrophic sequence risk than a 62-year-old with the same discipline and temperament. The academic literature on this is fairly consistent. What makes someone vulnerable is rigidity, not early exit. Specifically, the inability or unwillingness to temporarily reduce discretionary spending during a significant market drawdown. I find it genuinely amusing in an amused disappointment kind of way that the loudest warnings about sequence of returns risk tend to come from practitioners whose compensation is directly tied to the size of your portfolio under management. That is not a conspiracy. That is an incentive structure. The firm that charges you 1% annually of your assets has a built-in interest in you accumulating more of them and delaying distributions as long as possible. Understanding incentive structures is where the real clarity lives in personal finance. Let me make the three-window strategy concrete with a specific scenario, because abstract strategy doesn't land the same way as a specific example with real numbers. Tom is 55 years old and just retired. He has $1.22 million in a traditional IRA, $300,000 in a taxable brokerage account, and $250,000 in a Roth IRA. His brokerage account contains approximately $200,000 in unrealized long-term capital gains from index funds purchased steadily over the previous 20 years. In year one of retirement, Tom manages his draws to produce $65,000 in total taxable income. He converts $40,000 from his traditional IRA to his Roth, which at the 22% bracket costs him $8,800 in federal tax. He sells some of his appreciated brokerage holdings and realizes $22,000 in long-term capital gains at 0% federal rate because his taxable income keeps him below the married filing jointly threshold. He resets that cost basis permanently. His total federal income tax for the year is approximately $8,800 on $65,000 of managed income. His effective federal rate is around 13.5%. Tom's former colleague, Kevin, had an identical portfolio at 55 and kept working until 62. Kevin's effective federal rate during those 7 working years averaged 24% on his professional salary. Kevin did no Roth conversions because his income bracket made meaningful conversions financially inefficient. Kevin harvested no capital gains at 0% because his salary made it impossible. When Kevin reaches 73, his traditional IRA has grown larger in nominal terms, but his required minimum distributions are higher than Tom's. His Roth is smaller. And IRMA income thresholds for Medicare Part B and Part D are being triggered by his RMDs, adding a premium surcharge on top of standard Medicare costs. Kevin's lifetime federal tax bill compared to Tom's is higher by somewhere between $150,000 and $230,000 over a 20-year retirement horizon, depending on market returns and bracket progression. Kevin worked 7 additional years. He ended up in a worse tax position. He paid more rent on a building he already owned for 7 years, and the rent eroded the building's value while he wasn't looking. I asked Dave one question. If I could give you a written guarantee that you would not run out of money and your wife would have everything she needed, would you retire next month? He said yes, without any hesitation. That's when we both understood the real situation. He wasn't waiting for more money. He was waiting for permission. And permission never arrives from outside. It is not a financial instrument. You cannot accumulate it. Dave put in his notice 8 months after our first conversation. He was 55 years and 3 months old. He sent me a message from a national park in Utah 6 weeks later. I won't quote it because it would embarrass him. The short version: he spent 2 weeks being convinced he'd made a mistake. Then one morning, the fear was simply gone. He said the building was exactly as advertised. Another conversation I have observed in spirit in financial planning offices across this country for the last 25 years. Advisor, presenting the 3-bucket withdrawal strategy for a 56-year-old with $1.4 million. Client, narrowing his eyes. But what about the volatility in years 1 and 2? Advisor, showing a Monte Carlo simulation with a 94% success rate across 1,000 scenarios. Client, nodding. Can we do this for 61 and 2 months instead? Advisor, suppressing everything he wants to say. Here are 3 specific things to do with this information, calibrated exactly to this decision and not recycled from any other retirement video you have ever watched. First, calculate your real lease cost before you calculate anything else. Add up every monthly expense that exists solely because you work. Commuting, professional wardrobe, the convenience premium you pay on food and services because your time is not your own, any recurring healthcare spending that plausibly correlates with occupational stress. Multiply the monthly total by 84. That is 7 years of lease payments in pure cash outflows before you count a single dollar of tax opportunity cost or foregone optimization. If that number is above $100,000, and for most professional earners it will be, your ongoing employment calculation has been missing a significant line item. Second, before any other retirement number means anything to you, get the Roth conversion sequencing mapped. If your pre-tax accounts total more than $500,000, the tax differential available between the age you could retire and the age your required minimum distributions begin is almost certainly the highest return financial opportunity you have access to right now. Not market allocation, not fund selection. The sequence and rate at which you draw accounts and time your conversions. Common windows for Roth conversions include early retirement before Social Security and RMDs begin, years with business losses, and the gap between retirement and age 73 when RMDs start. Find a fee-only advisor who specializes in withdrawal sequencing and tax planning for early retirees. Not a generalist, not someone whose annual revenue scales with your balance. Someone whose entire job is optimizing the order of your draws and the timing of your conversions. Getting this wrong is a 6-figure mistake that compounds in the wrong direction for 2 decades. Third, run the stress test before you run the best case. Build the version of your plan that survives a 30% market drop in year 1 of retirement. Model an unexpected medical expense of $75,000 in year 3. Model a significant financial bridge for a family member. If the plan survives those scenarios with adjustments you could actually make, not theoretical adjustments, adjustments you would genuinely make, then you have your answer, not a number that makes you feel safe, an actual answer. The difference between those 2 things is the difference between moving into the building and paying rent on it indefinitely while convincing yourself that one more payment will make it yours. The 62 eligibility threshold was designed for a population with a life expectancy of 69.8 years. You are almost certainly not planning for that version of retirement. In 2023, a US newborn can expect to live to 78.4 years, and a 55-year-old who has already survived infancy and young adulthood has substantially longer expected longevity than that. You are potentially planning for a 30-year retirement. Stop letting a 1961 actuarial table designed to minimize the program's liability be the architecture of your financial life. Lazy investing built more fortune than crypto memes. The 62 number was never meant to be your number. It was meant to be theirs.